Hello and welcome to edition number 2 of the Share Show with Jeff Fitzpatrick, recorded on the 11th of May 2021. And in this edition, we're going to look at an insight. This week, we're talking about lid trades, in the money, what's happening in the world of trading. I'm also going to take a look at a pension forecast that I've been working on with one of the members this week. And then finally, we'll have in the news. Okay, so lid trades. I've been asked the question several times, what are lid trades and why do we use them when we sell a put? Well, they serve three purposes. The first, as with hot coffee, they stop us getting burned. Secondly, they reduce our exposure. And thirdly, they release buying power so we can have more trades. I'm going to explain this by using some examples. These are current trades from the Diamond Trading Account. First then, ALKS. This is where the stock price at expiration is higher than the strike price of the put that was sold. And being fair, we're still a week or two away from expiration date, so you'll have to use some imagination. We sold the ALKS May 2021 $22 strike price put, and we got $3.45 per share for that put. And we bought a protective put, which we call a lid, at the strike price of $21 for the same expiration date. And we used 10% of the income that we got, so basically 10% of $3.45, so we used 35 cents to pay for that protective put. If the stock price of ALKS stays the same as it is now at expiration, we'll just keep our $3.45 and we'll accept the fact that we spent 35 cents. So we'll be $3.10 better off. So in this case, it's like having bought insurance but not having used it. But as with all insurance, it's actually better not to have had a fire and therefore have had to make a claim. For the second example, I'm using Ericsson. And Ericsson's price is currently in between that of the strike price of the put that we sold and the strike price of the lid that we bought. We sold the Ericsson May 2021 $14 strike price put, and we got $1.37 per share for it. And we used about 10% of our money, 14 cents, to pay for a put that we would buy, and that would give us the right to sell this share. We sold a put, which is basically a promise that we would buy these shares up to the third Friday in May for $14 each. But we bought a put that said we also have the right to sell the shares for $13 each. So that would mean that if we had to use it, we would lose $1. But of course, we had been paid $1.37 for the put originally. Take away from that the 14 cents, and it's obvious that we couldn't actually lose on this trade. So come expiration, we have some choices. If the prices stay the same as they are now, we would probably just allow the Ericsson shares to be put to us, and then we decide what to do with them after that. We could just keep them, or we could start selling call options against them. But whatever happens, at that point in time, we would have choices and we'd have profit in the account. And in this third example, using KGC, a mining company, the stock price at expiration would be lower than the price of the put that we sold and lower than the lid strike price. So we sold the KGC May 2021 $9 strike price put, and we got $2.38 for it. And we bought the protective put, the lid, at a strike price of $8, again using 10% of our income. So in this case, we actually used 35 cents. So if things stay the same now, we will have to buy these shares for $9 and we'll sell them for $8, and our gain will be $1.03. So in that instance, we'd be really pleased that we had the insurance. But as with all three of these instances, we're in a no-lose situation. But why do we use 10% of our income as the figure that we want to use to invest in that insurance? It's actually a matter of judgment. If we paid, say, 90% of our income, then we'd be very, very safe, but we wouldn't be making very much money. And on the other hand, if we paid just, say, 1% of our income to put the put in place, it's highly likely that it wouldn't trigger and would have very little protection. So through experience, we've found that 10% gives us enough protection while not biting too much into the gains. But it is a judgment, and it's not a perfect, it's not a calculated figure. You could use a different one if you wish to. So let's reduce our exposure and place us in a no-lose situation. A less obvious benefit is that they release buying power to let us enter into further trades. So what I mean by that is, let's say we promise to buy some shares for $40. That's a big promise. And that promise would mean that we'd have to hold a lot of cash in reserve to pay for the shares. If, however, we're able to buy the right very cheaply to be able to sell those shares again for $39, then our exposure comes down from $40 to $1. And we've got then another $39 of buying power to be able to use for future trades. So effectively, lids make our buying power recyclable, just like this lid. Hopefully you've now got a little bit further insight into why we use lids. So next, inside track, what's happening in the market? We're getting mixed messages from the indices. So as far as the S&P 500 index is concerned, we're in that fast lane right at the top, and things are looking as if they are continuing with some strength at the moment, no problem. Meanwhile, across on the NASDAQ, we're at the bottom of the lower of the two tracks on where the index is going. So one of two things could happen there. Either we could hit that resistance line and bounce off and everything continues to go up, or it could actually break through that resistance and move to a lower level. So we're watching this very carefully this week to see what's happening in the overall market. However, as we know, the overall market is a guide. It certainly doesn't represent every stock. And in fact, a lot of the stocks that we trade are not even in either of those indices. There are many stocks that go against that overall trend. Our job is to find them in the event that they're going down, and also to make sure that we've got risk management and mitigation in place in case things do decide to take an overall reduction. However, I've got to say, touch wood, we're not too concerned, because even if we do get those reductions, we're still within trend, and we'll always get those ups and downs. The market never goes in a straight line. And for my tips of the week, I'm going with BlackBerry again, which I went with last week, and it's actually reduced in price. So at the close of play yesterday, BlackBerry was $8.13. Last week, it was $8.36, but it's still forecast to rise to $12. That would give it a 47.6% rise. And remember, this stock's got really good fundamentals, and it also gives very good call premiums. Meanwhile, my second pick is Meridian Bioscience. The ticker symbol is VIVO. It closed yesterday at $18.51, but it's forecast to rise to $30. That's $11.49, a 62% gain. And the October 25 strike price put is currently paying $8. That's 32% as a return on investment. As you can imagine, the clubs that I'm involved with are all in these trades. And next we go to a roundup of what's happening around those clubs. Tees Traders, Pentland, Diamond and Fortune 200. And first of all, Tees. Tees has made a good start to May, and the net liquid value is up 5.2%, and that doesn't involve any new money going into the account. And we haven't had expiration yet, so it looks as if it's going to be a good month for Tees. And next, Pentland. Pentland is getting back into cash, ready to merge with Fortune 200. So we're being very careful about entering new trades. Nonetheless, in the month so far, it has done 1.4%. Not bad for 10 days, wherever you choose to invest. And then we have Diamond. Diamond is also up 4.26% in the first 10 days of May. Again, looking very healthy, and that doesn't include any new money going into the account. So I'm very happy with the progress that we're making in Diamond. And last but not least, Fortune 200 partnership, still growing, still bringing in members, and up this month so far at 3.3%. Slightly less than Tees or Diamond, And I think that's because the buying power of Fortune is still smaller than those two clubs, and the price of the stocks that it can get involved with is therefore lower, and therefore our choice is lower. That said, I'm still betting my money on Fortune 200 doing very, very well. And now a word about retirement planning. One of our members asked me to help them this week with some retirement planning. Now, I'm not an independent financial advisor and I don't give advice, but I was able to help. The member plans to retire in 15 years. So I put together a spreadsheet to allow them to do their own forecasting. The member chooses the investment level, puts in their choice of return, the tax rate, and the exchange rate. So I'm not doing any forecasting at all. So let's see what they came up with. These figures relate to year 15, and they've been putting in £150 per month for those 15 years, never missing but never increasing it either. The exchange rate is the current exchange rate, about 1.4. They've used a monthly gain of 6% and the tax rate at 40%. Who knows what the tax rate might be in 15 years' time, but never mind. The reference to training there, the 150, is what they were paying, but that was only right back at the beginning when they were still paying for their training. By the end, this account should be worth about $1 million based on those parameters. However, 15 years is a very long time. And also, in 15 years' time, you would think that £150 per month wouldn't be a great deal of money. So let's have a look at another set of figures and see how that might change. This is again year 15, but by now, having increased the monthly investment by £50 per month in each year, then they're up to £850 per month. The exchange rate, the monthly gain of 6%, and the tax rate are all the same. There's no training fees at this stage in the game. They're now finishing off this session with well over 1.5 million. However, by the time you get into 15 years, that's a long, long time. So let me show you one more chart. This is the same investment regime, starting off with £150 per month in year 1, taking that to 200 in year 2, 250 in year 3, and so on. And we're now up to year 6, and the monthly investment is £400. The other factors have all stayed the same. And it's not so much the end figure, it's the annual gain. And that's over $40,000. And with that sort of income, you might want to look again at your retirement plan and bring it forward from 15 years. You could even go after 6. So this is a clear demonstration that it's a good idea to keep updating the amount of money that you're investing as we go forward. If anyone would like this spreadsheet to put their own figures into and have a play around and see where they might end up, then just get in touch. I'll gladly send you it. And you can then input your own monthly investments, exchange rates, etc. And finally, a couple of news items. First of all, meeting dates, and the next meeting for Diamond, Tees and Fortune is Thursday, the 20th of May. Now, I'm not actually going to be around on Thursday, the 20th of May. I'm actually going away for a few days. So we may have to make alternative arrangements, either to have Owen just take the meeting, or we can move it to the Friday, probably a bit earlier. So we'll be consulting on that shortly. I'm also pleased to announce the launch of Privilege. Privilege is a new program that we put together for individuals and for very small syndicates, sort of 4 or 5 people, who are looking to invest at least £100,000 per member. The returns and costs and the forecasts will be very similar to those of Diamond and Fortune, but the account owners will have more personal control and involvement in what, when, and how they trade. There's a brochure on the smartinvestments.ai website that anyone is welcome to download and have a look at, and pass it to anybody that you think may be interested. I should add that we already work with individuals who have significant accounts. I've been working on one this week, which has actually gone from $1.4 million to $3 million in the last 12 months. And finally, don't forget to stop by the Smart Investments Facebook page And keep an eye out there for any news and major announcements, because they'll be going in there first. Thanks again. Lovely to talk to you, and I'll see you all soon.